Welcome to the Daily Update, where I'll go over the action in the market for Monday, July 17th, and then we'll see how things look for Tuesday, July 18th. We had another update. The market seems to be defying gravity. There were lots of reasons why we should have seen a pullback in Monday's session, but yet we drifted higher nonetheless. However, at the same time, we might be seeing a few entrances of some stealth weakness coming into the market. And as I go through the charts, I'll try to show you that. But we're still looking positive. The market is still going with this rosy scenario that maybe the Fed is getting close to being done with raising interest rates. Maybe the earnings will grow into the future, and so everybody appears to be happy. Now, this can change at any time. One news story, one big sell program during the day, something coming out that someone says, all of that can end up changing things, but we just have to take this day by day. If we do see some weakness coming into the market, we'll just fall back, regroup, evaluate things, see if things are turning more negative. But for right now, things still remain positive, but we're still overbought. And the more we go up, the more overbought we become. And at some point, we're due for some kind of a pullback. We're kind of waiting to see, can the market work off some of this overbought situation by moving more sideways, or are we going to see some kind of a decline? If we do see a decline, that's when we'll reevaluate and just look at things to see if it's switching more negative. We are coming into a seasonally weak time of the month, which is also applied to the whole summer, so we want to be aware of that. But that's historical averages. Anything can end up happening. We're just going based on what has happened in the past. So let's go back and talk about what happened. Right at the open, we had a higher open, and prices climbed above the daily pivot at 41.11. As the day went on, we climbed to almost R1 initially at 45.22. We drifted a bit before going above R1, and then we closed a little bit down right at R1. We were up 0.39%. And volume continues to be about average. We're not above average. We're not below average. We're pretty much at average right now. The technicals are positive. The market's fixated on inflation and interest rates. They're worried about what's growth going to be like going into the future. They seem to be appeased with that right now. So we'll have to take that and just go with it. What are some comments that we can make? Is slight weakness entering the market? And that'll become apparent as I go through some of these charts. The VIX was up on an up day. That's kind of strange. Usually it goes down on an up day. The S&P did make another 52-week high. The positive scenario continues that I just talked about. They think we're going to have a soft landing. There's a real chance for that. And some of our charts are actually suggesting that. No matter how many charts you look at to suggest we could go into a recession. And there's a lot of them, and there's a lot of substantial evidence. There's also a lot of evidence that suggests that maybe we won't. Ultimately, it's the market that plays this scenario out, and so far they think that we will have a soft landing and that the Fed is almost done and that future earnings will continue to grow. On a short-term basis, we still have a long list, though. The CMB composite, the CCI 14 and 20, the Stochk RSI, the Williams percent R, our standard deviation chart, the stochastics, the boom indicator based on 20 periods, the RSI 9 period. All of those are looking extreme positive. Yes, we could still even go up from here, but this list just continues to suggest that we're getting overbought in the short term and even in the intermediate term. We have the balance of power, our Arun indicator, the PMO studies, our oscillators. Even though they're showing a lot of improvement, we're still looking at those negative divergences that we're seeing. The Sean trend meter, the BPI, both for the S&P as well as the NASDAQ 100. The Boom 50 indicator, and the RSI 14. The dollar declined and interest rates were down, and this gave some support to stocks. We still have all of the yield curves that remain inverted. Sentiment is extreme, where it's at 80, where the last close we had at 79. Our trend is positive, but even with the up day, the green line's coming down, and it's looking rather extreme. But the ADX is above its moving average, so it's getting stronger, and both of them are above 20. Our bias is positive and our momentum is positive. The one thing that I want to reiterate that I say from time to time, I try to be as objective as possible. I try to let the charts speak for themselves. The only subjective part where I actually come up with my own conclusion is the bias and the momentum. Bias is if we had an up or a down day, typically. Momentum is the last 2, 3, 4, 5 days. That's where I kind of reach my own conclusion. I try to let everything else speak for itself. The economic reports that came out, we just had one. It was the Empire State Manufacturing Survey, which came in at 1.1. They expected it to be down 8.8. Last time we had the report, it was up 6.6. Here is a chart showing how the Empire State Manufacturing has changed over time. We're right about at the zero line, and we've been chopping around. This is a pretty emotional type of survey, especially right now. You get good months, bad months. It's kind of hard to see an overall trend happening here because we're just bouncing all over the place. Some Isabel Net blog charts. First of all, margin expectations have fallen. Record margins are no longer penciled in by analysts. The yellow area here does show that earnings should get better, but they're not as high as they were. They had their projections going above some of the blue readings that we had already received, but it does show an overall improvement, but they have lowered these. Also, looking at the 12-month forward PE blended with what's already came out versus what still has yet to come, we're at 19.59. This is one area that I address in the weekly videos. Then when looking at the central bank liquidity and the NASDAQ, they typically have a strong correlation with each other. When the central banks have more liquidity, the NASDAQ tends to go up. Now we're seeing a real divergence here. Is that going to have some kind of an impact? We're also seeing a lot of flows right now coming out of TIPS. These are adjusted for inflation. They're shorter term, and the interest rate on these can change. So when you have shorter term bonds and interest rates are going up, you renew at the higher interest rate. And that's good to have when rates are going up. With people getting out of these, that means that a lot of folks are tending to think maybe interest rates are not going to keep going up, and so we can get into longer maturity bonds. At the top, you see where a lot of money continues to flow into Japan. We're also looking at the bubble in T-bills being over now. A lot of money was going into T-bills. These are short term, kind of like the TIPS. And it's showing that a lot of money's coming out. And this is what folks do when they're worried about inflation, when they're worried about interest rates going up. They get into these. Well, as we're seeing inflation coming down, folks are starting to get out of these and get into longer term maturities. The defensive stocks, healthcare specifically, is really seeing a lot of outflows. They held up pretty well in 2022. That's a defensive type of investment. Now, folks are turning back more to the growth-oriented investments. Then looking at the Morgan Stanley price target a year from now, which will be mid-year 2024, if earnings go up to $253, that's the bullish case. That would give us a multiple of 18.6. That would put us at about 4,700 with the S&P. That's about 6.8% from where we're at. The base case, if things just stay the same at $239 for earnings, that would give us a multiple of 17.6 and put us at about 4,200, which is actually below where we're at right now, so we would need to decline to get to that point. In the bearish case, things really turn bad and earnings drop down to 222. That would give us a multiple of 16.7. We would drop 15.9% from here to get us down to 3,700. They base this on the S&P being at just about 4,400. We're now at 4,500 with the S&P. Then, looking at significant multiple expansion, this is going to play out, and I underline this, because of elevated expectations for earnings. Earnings are going to have to really go up for this scenario to play out, where the market goes up and the PE ratio stays under control. That reduces the risk premium. That means that stocks are not really expensive, so you're not throwing money in that could turn the market lower, and then you see losses. And we're also seeing an increase in the 10-year yields, which we're also wondering, are we starting to shift back to more of a new normal with that, as interest rates have been going back up? Looking at our charts and analysis, here's the intraday chart. We had a positive open, no real gap. We were able to quickly get above the daily pivot. We danced along there for a while. The market didn't really know what it wanted to do, but it ended up going higher. We almost made it up to R1, dropped back a little bit. We just drifted, then eventually went above R1, but then saw some selling going into the close, and we closed back down at R1. Here's the intraday chart, where Friday we had pretty much seen a pretty slow session, saw a little bit of weakness in the pre-market session. Then we saw some strength coming into when the market opened, then some weakness going into the close, and we're pretty much flat in the initial overnight session. Looking at growth versus value, where growth is outperforming value even though they decline near the end of the day. This is an intraday chart, but they were both positive. So when we look at this on a closing basis, growth outperformed value for the large caps, the mid caps, as well as the small caps. So growth had a pretty good day. Here's the S&P growth to value ratio chart where we're above the dashed line here. So we were positive and we ended up closing pretty much near the high for the day. That's one of the positive signs. We're seeing money going back into growth stocks. Sentiment is still very, very low. With our Ulcer Index, it continues to show there's no fear. We ticked up just a little bit with the VIX on the line chart as well as the bar chart. Kind of strange on an up day. And volatility has been ticking up just a little bit, but continues to tread more or less sideways. The SKU index, after almost coming up to this extreme area, we're there again. And we're just wondering, is this going to give us some kind of a signal? If we get into this red area, typically that's where the market expects some kind of a big move. Sometimes that move is up, sometimes that move is down. We don't really know what that will be, so we'll have to look at the context at that time. Also looking at the equity put call ratio, it continues to decline as stocks have been going up. We haven't really been working off of a big signal here. The real strong signals are when we go above this red line and then start to drop. Well, we didn't get above it last time, but the equity put call ratio continues to fall. The equity put call ratio longer term also continues to fall, which is positive. Looking at the VIX to S&P 500 correlation, we're dropping down below this dashed line. Again, we're not quite sure. Is this going to be something positive or negative? You can make a case for either side. Sometimes the market has moved up after this signal. Sometimes it's gone down. Looking at the VIX to move ratio shows that there's not a lot of fear in the market. Looking at the move index, which measures the volatility of bonds, it ticked up just a little bit, and the VIX ticked up just a little bit. We're seeing a real strong correlation between these two indexes. When we look at this other fear gauge, we ticked down just a little bit, and we're continuing to fall overall, even though we did tick up recently. This other fear gauge also continues to decline. And folks are still favoring a risk-on posture. This ratio continues to advance. Our advanced decline line studies, we were flat to slightly down based on price and declined a little bit based on volume. This might be just a teeny tiny bit of weakness. Maybe I'm looking with a magnifying glass too much, but you would think on an up day that we would have seen this improve more than it did. Looking at the new highs, new lows, we are seeing an expansion of new highs, but it's not turning our 5-period moving average up, and the 10-period has now started to go down. Another potential area of possible weakness. The advanced decline ratio declined on an up day, but it's still positive, but this might be another area just to be aware of. Accumulation distribution, this still looks positive. It's turning back up and above the moving average. We're also seeing just a little bit of a tick up with our cumulative advanced decline line for the NYSE. We're also seeing a little bit of improvement with the NYSE advanced decline line. And this advanced decline line continues to be above this upward sloping trend line. When we look at the common stock for the advanced decline line based on price, we ticked up barely, and we actually declined a little bit based on volume. Another potential area of weakness. Looking at our advanced decline line studies, we ticked up with the NYSE, we were flat with the S&P, mid caps turned up and small caps turned up. Our trend, the green line is continuing to come down, it's above 40, however the ADX continues to be positive, so we still default to the positive side, but we're a little bit concerned because this green line is giving us a pretty extreme reading. However, you could switch that over and say, no, it's not giving an extreme reading, it's just showing good solid momentum. Looking at our short-term ADX, also seeing a decline with the red line where the ADX continues to advance. Volume did pick up to average a little bit, but still it's only average. And then our short-term charts, not really much was decided here. If we continue to go up, we might have some overhead resistance at a pivot level, as well as bumping into this upward sloping trend line. We haven't really fallen all that much yet to really see if we're hitting any kind of support. On the bottom, you can see where volume was just about average. We're still looking good here with the double and triple exponential moving average based on 20 periods. We're above both of them right now and advancing. We're coming down just a little bit with our 20 period exponential moving average. We turned down after being extreme with the 50 and we're declining slightly with the 200. Another area of some slight weakness to be aware of. The Stochc RSI actually ticked up and continues to be extreme positive, as is the Williams %R. The CCI 14 came down just a little bit, but is still extreme. And the CCI 20 also declined a little bit, but is still extreme positive. The short-term stochastics looking pretty extreme in the short term. We continue to go up in the intermediate short term, so that's extreme. And we're turning back up with our longer-term stochastic, and all three of these are now extreme positive. The force index ticked up just a little bit and is positive. Looking at some intermediate charts, the balance of power continues to go up. We haven't seen this high of a reading unless you go back to November of 2021. The CMB composite is above this black line and continuing to advance, so it's looking extreme positive. We're above the double and triple exponential moving averages based on 50 periods, so this is showing good solid upward movement. The go-no-go system still remains positive. The highest high is still showing that we are advancing, suggesting good momentum. The TTM squeeze is also improving with the lighter colored blue bars. The boom indicator, the 20 period, starting to get a little bit above this level here, just suggesting that we're extreme positive. We're seeing it a little bit extreme positive with the 50 period. We continue to show improvement with the 200 period moving average. We're still up in the third standard deviation on this chart, suggesting that we continue to go up too far too fast. And this is a chart I haven't shown in a while. The 50 period rate of change looks like we're getting extreme positive again. This could suggest good momentum. There's nothing to say that this can't continue to go up. We just want to be aware of this. Looking at the ease of movement, after coming down to 0, continues to bounce upward. That's positive. The PPO studies continue to be positive in all different time frames. The Erin indicators going back up and giving us an extreme positive reading. When the green line is pegged near the top, that means buyers are in full control. With the red line declining, that means sellers aren't really having much of an impact. The S&P McClellan oscillator, after almost giving us an extreme positive reading, continues to decline, another slight sign of weakness. But our summation index based on price continues to advance, and we're kind of starting to flatten out based on volume. One thing to be aware of, the top part of this chart and the bottom part of this chart are calculated in different ways. So sometimes we get different readings from this, which can give us clues as to what's happening. So we want to keep an eye on this flattening out of the volume. The NYSE McClellan oscillator also declined, but it's still positive and above 0. So when we look at the summation index based on price, that's advancing as well as volume. The Swenlin trading oscillator turned down just a little bit based on price and was pretty much flat based on volume, another slight sign of weakness. The Elder Impulse system for the S&P 500 still remains positive. Our PMO starting to turn back more positive. We're advancing based on price, and we're pretty much sideways, but still advancing based on volume. Our PMO study, the percent of PMOs that are rising, was flat. We declined a little bit with the buy signals, another slight sign of weakness. We're turning down a little bit with the PMOs that are above 0, but as I stated in the last video, this could also suggest good solid participation by the broader market, by more of the stocks that are in the S&P 500, but we are turning down just a little bit. However, the parabolic SAR remains positive with the dots underneath. The slope indicator is now turning back up and looking positive. The MACD is also looking positive. When we look at all of our oscillators, we still want to be aware of these negative divergences, but we're showing some real improvement, especially in our short term and somewhat in our intermediate term. The longer term oscillators, this is still flat for the tricks, and we're still pretty much declining with the KST. The bullish percent index continues to advance. On the positive side, that means solid participation. On the negative side, we're starting to get extreme positive. The NYSE bullish percent index ticked up just a little bit and continues to improve. The Sean trend meter, it ticked down a little bit, but is still extreme positive. The Chaikin oscillator also declined, maybe a sign of some weakness. Here's another slight sign of weakness. The Chaikin money flow continues to be positive, but it has now declined 3 days in a row. This tries to measure institutional buying and selling. Is there some selling going on into strength? The money flow index is still positive, above 50 and advancing. Ultimate oscillator above 50 and advancing. The vortex, the green line, continues to advance. That's positive. The on-balance volume is also positive above the moving average. The RSI based on 14 and 9 periods, we're still worried about this negative divergence here, but it could be negated now because we're seeing the RSI starting to come back up, but it is extreme positive. The RSI 9 is also starting to come back up, and it has been extreme positive for a few days now. The Coppet curve generated a recent buy signal. Looking at our moving average study for the S&P, we ticked down just a little bit, another sign of potential weakness with the 200-day moving average, and we ticked down with the 50-period moving average. We look at this on the same chart, only with a histogram instead, also showing how we declined slightly. I don't have any Fibonacci or line studies now because we're in no man's land with all the charts that I've been using. So looking at our different charts, the Heiken Ashi still remains positive, the Kegi is still positive, the Renko is positive, and the 3-line break is positive. I haven't shown this in a while. There's nothing new on the point and figure chart. We're still working off of a signal of a double top breakout that was generated on May 18th. Looking at some of our other indexes, we turned up a little bit with the equal weight index, but we're still underperforming the S&P. The ratio did tick up though, so on a daily basis, the equal weight outperformed the S&P, but overall, the S&P has been outperforming. We're seeing a little bit of a breakout with the Dow here as it continues to go up, but nothing really significant. We're going pretty much flat now with the transports after we had broken out. That could be another little potential weakness. We saw a little bit of a turn down in utilities, which often gives some support to the S&P. Looking at our ratio between the transports and the S&P, we did decline, but we're still going up overall. We want to see this ratio really going up, and it's not doing that now for the last 2 or 3 days. And we're looking at the correlation between the S&P and the transports. It's showing a little bit of improvement, but not as strong as it can get. The Dow and the transports are just about performing about the same. Looking at our discretionary equal weight versus our staples equal weight, we turned down a little bit with discretionary, a little bit with staples. Our ratio actually ticked up a little bit because discretionary was down less, and so we're seeing some improvement overall. The Dow still having a hard time breaking above these recent highs here. We get above it a little bit only to close right back down at it. But the diamonds still remain positive for the Elders Impulse system. The NASDAQ, this is encouraging. We were able to get above R1 and close above R1, which had been resistance for the last 2 trading days. The fact that we closed above this is positive. When we look at the NASDAQ with our 61.8% retracement level, we are starting to go above that. The longer we can stay above it, if we start to come down, the more likely this is to act as support. But we're also seeing weakness when we take the cumulative count of new highs minus the new lows, even though it turned up just a little bit. When we take the raw score, new highs minus the new lows, we continue to be positive. We're also looking a little better here with the NASDAQ 100. We were able to get above this R1 level and close above that level. So that's positive. The longer we can stay above this, if we start to fall back, we hope that this might end up providing support for the NASDAQ 100. The Elder Impulse system for the NASDAQ 100 continues to be positive, and we're pretty much in no man's land as far as the Fibonacci retracements are concerned. We're getting pretty extreme and kind of turning over just a little bit with our BPI of the NASDAQ 100. This could still go up. It could even start to come down. A few weeks ago, it was thought that this was a major sell signal. Well, we came back and pretty much blew that out. We're getting even more extreme now. If we start to roll over, is that going to be a more powerful sell signal? The Qs continue to outperform the Dow, but the correlation is still pretty strong with each other. The FANG index, another area that we're looking at here, it's in an overall uptrend, and we're coming back and testing the previous all-time high. We actually closed just a little bit above that. That could also be positive. Are we going to be able to break above that with more strength, or are we going to fall back down below this resistance level? The small cap index had a pretty good day, but came right back up to prices where it was at not so long ago. The small caps for the Elder Impulse system have switched over to positive. And looking at the Russell 2000 index, where we are still above this support level, which depending on the context could be either support or resistance, we have seen a golden cross with the Russell 2000. The MACD is positive. We're turning back up with the RSI, but we could start to get to an extreme positive reading. The small caps continue to underperform the S&P, and in a good solid environment, we want to see small caps participating more than they have been. The mid caps also coming up to this R1 level and have not been able to break through that yet. They continue to be neutral for the Elders Impulse system, but when we look at mid cap growth versus mid cap value, we're really going up with growth. This is some internal strength that we're seeing in the market. The home builders did have another good day. They went up. The S&P did advance, but not very much, so it kind of rolled over our ratio. But the relationship between the two is still very strong. We're not really seeing anything of note in this chart, other than the home builders and the S&P are confirming strength in each other. The dollar index has now dropped below 100, and that is also giving some support to stocks. The tech sector continues to outperform bonds, and the broad market, S&P 1500, is outperforming bonds. And the broad market, when we look at further out bonds, continues to outperform. So stocks are outperforming bonds. When we look at small cap growth versus value, it did turn up, but we've been chopping sideways lately, even though we remain in an uptrend. The S&P is also continuing to outperform bonds, suggesting that we might see a soft landing. The home construction ticked down just a little bit, but continues to be very strong when compared to bonds. Growth continues to outperform value and is showing some improvement. Keeping an eye on the financial sector, we're above the 50 and 200-day moving average, but we haven't come back to a golden cross yet. The financials are still underperforming the S&P, but we're coming back up and testing this 50-period moving average with this ratio. But the regional banking ETF ticked down just a little bit compared to the financial sector and continued to be in an overall downtrend. Bonds, we were down a little bit based on yield. After really spiking up and coming back down, we fell a little bit more in Monday's session, even though we're seeing a recent golden cross with the 10-year bond yield. When we look at bond prices, they were up slightly. We're above the 200-period moving average, but we have not been able to break above the 50-period moving average. The RSI is above 50 and advancing. That's positive, and the MACD is also looking positive. We're seeing a little bit of a decline in the ratio between risky and conservative bonds, but they still favor the more risky bonds. We're looking at the S&P 500 to the long-term bond ETF. We're seeing a little bit of improvement in the longer-term relationship. Shorter term, we're also seeing an improvement, but the spread between the two continues to be very wide. We're also a little bit concerned about this. I've been bringing this up pretty much in every video. If the market was more convinced about interest rates when you compare cash to the 3 to 7 year bond ETF, this ratio would be going down. And it was going down for a while, but then it turned and started to go back up. It was really topping out and is now possibly coming down. However, we've seen a recent golden cross with this ratio. We're also keeping an eye on the 3-month yield going back to 2007. We continue to be above that level. We're still asking the question, if we start to drop back down, is that going to give us some kind of a warning sign? Our long-term charts, the Special K daily chart continues to look more positive. Please keep in mind the weekly chart is still negative. Our moving average study also seeing just a little bit of weakness with the 150, and we were pretty much flat with the 200. Nothing all that big. These are all just things that I noticed as I was looking through the charts. The rate of change going back 200 periods is showing a lot of improvement, so this is suggesting there's good solid upward momentum. Then looking at our weekly charts of the S&P, we're still right about on this resistance level now. The market hasn't really decided. Are we going to break and go above this, or is this going to provide resistance and we're going to fall back down? That is still yet to be determined. We're also a little bit above this resistance level with the NASDAQ 100. This is looking more positive. If we can continue to see more strength in the NASDAQ 100, maybe it will pull the S&P 500 up with it. And the inverse of that could also be true. When we look at the NASDAQ 100 to Dow ratio, we're coming back to a pretty extreme reading, and it could still go higher. There's nothing that says it has to stop right here, but it did stop at about this point back in 2000. This was the dot-com boom. When we were declining, that was the dot-com bust. It took us many years to get back up to this point. Now we're showing some good strength again. We'll have to see if that can continue, or is this going to present a problem? An update of our possible positive scenarios. We saw where the Qs outperformed the S&P. Discretionary is outperforming the S&P. Large cap growth is outperforming large cap value. With the growth to value ratios, large cap showing improvement, mid caps improvement, and a little bit of improvement with the small caps. When we take a broad range of the highs minus the lows and then put a 5-period simple moving average on that, we continue to be positive. The S&P to utilities ratio continues to go up, which often gives good support to the S&P. We're still up in this upper area when we take the 10-day average of the S&P 500 highs minus the lows. The longer we're up here, the longer that suggests good solid momentum. We saw a little bit of improvement with S&P growth versus value, but we're still kind of concerned about this. We want to see this really going up, and it's not really doing that, even though it's still in an uptrend. The 50-period exponential moving average of the highs minus the lows continue to show improvement. Our indicator, which is the black line, continues to be positive, and then the red line, which is the moving average that we used on the previous chart, continues to advance. This is a chart that I've been kind of showing in and out from time to time. Typically, what will happen when the 2-year yield spikes and then comes down, that will often give good short-term to intermediate-term support to the S&P. The problem is they were both going in the same direction. The 2-year yield was going up as the S&P was going up, so this chart wasn't really helping us. Well, we've now seen a shift in that relationship, where the S&P and the 2-year yield over the last few days are now going in opposite directions. This isn't really telling us much yet. We just want to keep an eye on this to see if this will give some good support to the S&P. Then we're still seeing a decline in the Staples to S&P 500 ratio. This often does give very good support to the S&P 500. So what's our outlook for Tuesday? Bank of America, Morgan Stanley, Charles Schwab. They'll be coming out with their earnings report before the market opens. That really could set the tone for the day. The technicals are positive, but we continue to be overbought. We'll be getting retail sales. That can be pretty influential. Industrial production and capacity utilization, also influential. Business inventories, as well as the NAHB Housing Market Index. And then we're keeping an eye on the geopolitical events, but the market continues to be fixated on inflation and interest rates and wondering what's that going to do to growth into the future. Here's the updated calendar for the economic reports coming out, where we have the retail sales on Tuesday. Please keep in mind that we don't have any reports coming out on Friday. Here is the schedule for the Fed speak, and after these guys get done talking, Edward Yardeni made kind of a funny comment. The FOMC, he called it the Federal Open Mouth Committee because these guys like to talk. Well, after these speeches are done, they go into lockdown because that'll be leading up to the next FOMC meeting, and they're not supposed to talk to anybody during that time. The Stock Traders Almanac statistics for July 18th were neutral to negative with the Dow and S&P, where we're more neutral to positive with the NASDAQ. We're also going to be on the 11th trading day of the month, and this is when we start to see some seasonal weakness. Doesn't mean it's going to happen this time. This is just showing you what historically has already happened. Also, keep in mind that we're coming up to options expiration, which will be this coming Friday. We're also keeping an eye on the NASDAQ 100. We're getting to the middle part of July now, where seasonally and historically we have tended to see some weakness. So our scenarios, we can't really go with the down one now. We're just too positive at this point, but we are overbought. So we're defaulting to the positive scenario, but we are overbought, but things are still looking really positive for right now, with some potential areas of weakness possibly creeping in. We get a good solid update, those weak areas that I was talking about, those would just get wiped out immediately. And we're not going with the sideways trend right now because our ADX is above 20, showing that we're in a trending environment. Our warning signs, the longer-term trend signals may be signaling a top. So far, that hasn't happened. We don't know. We might break above that. We might come and break down below that. Seasonally and historically, this is a weak time of the month. Oscillators are negatively diverging, but they are showing some improvement. The VIX is still showing that there's not a lot of fear. It's been acting kind of strange, which is why we're watching the S&P to VIX correlation chart. The cumulative new highs, new lows continue to show overall weakness for the NASDAQ. The 3-month yield is above where it was in 2007, right before the great financial crisis. The S&P growth is showing some weakness. Even though we improved on Monday, we want to see that really show a lot more strength than it is. And then earnings season is starting to get underway again. The positive signs, way in the background, that apply to much longer term, we have positive seasonality as well as setups. The long-term Special K daily chart continues to be positive, where the weekly chart is still negative. The longer-term equity put-call ratio continues to be positive because it is declining. The S&P remains above that downtrend channel upper line. We're still in a risk-on posture, lower price levels. We haven't really fallen all that much, so we can still say, so far, support has held. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they are breaking out, and they broke out above this resistance. Can they stay above those levels and keep going up from here? The staples to S&P 500 ratio is declining, which can be positive for the S&P. The small cap index, measured by the Russell 2000 and the mid caps, generated recent golden crosses, but not the S&P small cap index that we also look at. Small and mid cap growth continues to be positive, and the Copic curve has generated a buy signal. So our conclusion, the S&P remains positive, but it's overbought. Short term, we're positive overbought. Intermediate term, positive overbought. Long term, we continue to be positive. Thank you. I hope this was helpful. I hope you have a really good day, and I will talk to you in the next video.